and welcome to our financial reporting, financial statement analysis, and valuation, a strategic perspective. We're going to be covering Chapter 1 today, which gives us an overview of financial reporting and financial statement analysis and valuation. So first and foremost, we want to discuss the 6-step process. And these are interrelated sequential steps that we conduct when we're doing our financial statement analysis. First and foremost, we want to identify any economic characteristics and competitive dynamics within the industry. Then we want to move to identify some of the company's strategies. Then we want to go and assess the quality of our financial statements. Then we want to analyze our profitability, our growth, and risk. Then we want to project our future financial statements. And lastly, we want to value the firm. So when we're doing step 1, where we're identifying the industry economic characteristics, we're looking for any type of competitive dynamics, anything that will influence the strategies of the firm. And as financial analysts, what we should consider are these economic characteristics and competitive dynamics when we're looking at and analyzing our financial statements to produce forecasted financial statements. So when we're looking at some industry economic characteristics, you see we want to look at our profit margin, we want to look at our return on assets, we want to look at our long-term debt to total assets or our total assets as well. So, and we have it for various industries. So there are several tools that we use when we're trying to study industry economics, right? Porter's 5 forces is the classification framework that we use, and we try to incorporate that into our value chain analysis, and we also might look at economic attributes framework as well. So when we're looking at Porter's 5 forces classification framework, we think about his horizontal and vertical competition. And in horizontal competition, we want to look at any rival among existing firms, and we want to analyze any threats of new entrants into the industry and any threats of substitutes to our product. And when we're looking at our vertical competition, we are looking at the buyer power and the supplier power. So when we're looking at the rivalry among existing firms, that is often the first order of our competition. And industries are usually characterized by some concentrated rivals or some diffused rivals. And so the greater the industry concentration, the lower the competition between existing rivals and the more profitable the firm will be. When we're looking at threats of new entrants, we want to see how easily new firms can enter the market. Are there any barriers to entry? Do the existing rivals, do they have any type of distinctive competitive advantage that's making it difficult for other firms to either enter or compete within the same industry? And if firms in the industries, then will it likely generate higher profits if there are new entrants and they can easily enter into the market? So these are all the types of questions that we're thinking and we're looking at when we're trying to see the threat of new entrants into the market. Then we also have to look at threats of substitutes, right? How easily can customers switch products or services? How likely are these customers to switch? And if there are close substitutes, is the competition increasing, and then would that decrease our profitability? Are there just a few unique products, but then they have few substitutes? Because if that's the case, then that will enhance our profitability. Then when we're looking at buyer power, here we're relating the number of buyers and sellers in the industry, and we're trying to leverage the buyers and what type of leverage these buyers have as it relates to the price of the product, right? So it relates to the buyer's price sensitivity and the elasticity of demand. Are they buyers price takers, or are they price setters? Then we're looking at supplier power. In this one, we're trying to leverage negotiating our input prices from suppliers. So if the industry has a large number of potential buyers of inputs, then they're produced, though, by a relatively few amount of suppliers. Thus, suppliers will then have greater power in setting those prices and generating their profits. Now let's talk about the value chain. And in this case, we're talking about the value chain for one of my favorite beverages, a coffee beverage industry, right? So we're looking at green coffee beans, right? They're grown and they're harvested. And then the coffee beans are shipped, roasted, and packaged. And then the packaged coffee beans are distributed to our retail sales location, and the retail sales are made to the customers by way of grocery stores or coffee shops. I think coffee is fuel, so I love this example. But keep in mind the value chain analysis, we're looking at each step, and we want to make sure that we're adding value to each of the steps. So we're going to look at the economic attributes framework, right? When you're thinking about this, you're thinking of supply, you're thinking of demand, what the manufacturing entails, the marketing of the product, and investing and financing activities of the organization. So demand. Our customers, are they highly price sensitive or are they insensitive to the price? Is demand growing or is it relatively mature? Does demand move with the economic cycle, or again, does this not have any sensitivity to it? Does demand vary with the seasons or vary throughout the time of year? These are all questions that we're asking to help us analyze the demand for our products. Supply. Are suppliers offering similar or unique products? Are there high barriers to entry into the industry? Are there high barriers to leaving the industry, such as like environmental cleanup costs, and we've seen that with oil spillages? And manufacturing. Is the manufacturing process, is that capital intensive or labor intensive? Right? So labor would mean that there's more people involvement, capital intensive meaning that there's more property, plant, and equipment. Or is it a combination of the two? And is the manufacturing process complex, right? That we have a low tolerance for error? Or do we have a very simple manufacturing process within the ranges of the products that we're doing and that we're producing all of the products within an acceptable quality? Marketing. How is our product promoted to other businesses, or do we just promote it directly to consumers? Does steady demand pull products through the distribution channel, or must firms continually create this demand over and over again? Investing and financing. Now, are the assets of the firm in the industry, do we have short-term or long-term assets? Is there high risk or low risk in terms of those assets as they relate to the industry? Is the industry profitable, or is it pretty mature where we're generating enough cash flows, or are we growing rapidly that we really need to get some external financing through debt or equity? So now we move on to the second step in our process where we want to identify company strategies. So here the framework is our strategy analysis. We're looking at the nature of the product or service, how we're going to integrate that product into the value chain, how we are geographically going to diversify the product, and how we're going to diversify within the industry as well. So the nature of the product or services, do we have some type of differentiation strategy? Do we have a unique product? Are we looking at having very high profit margins? Or do we have a low-cost leadership strategy where we do not have a differentiated product, but yet we're accepting this lower profit margin because we want a higher sales volume and a higher market share? So this lower profit margin, think of Walmart here. And then we want to integrate into the value chain, right? So if we're thinking about manufacturing or distributions. So in manufacturing, is the firm conducting all of the manufacturing operations themselves? Are they outsourcing a portion of it, or are they outsourcing components and then bringing them all back in-house to assemble them? And when we think of distribution, how is the firm maintaining control over this distribution function, or is it outsourcing the function in its totality? Then when we're looking at geographical diversification, what is the firm targeting its product? Is it just domestically, or are we looking across many countries and globally? And when we're thinking about industry diversification, are we operating in just one industry? Or are we looking to diversify and go across multiple industries at one time? These are all the types of ways in which we're asking these questions to identify the company's strategies. And we're trying to gather this information from internal stakeholders and possibly external stakeholders as well. So when we move on to step 3, one of my favorites we're going to assess the quality of the financial statements. So we're going to look at the income statement, which tells us our profits and loss. And then we're going to look at the balance sheet, which gives us assets equals liabilities plus owner's equity. Then we're going to look at the statement of cash flows, which has 3 central activities: operating, investing, and financing activities. Then we're going to look at the statement of shareholders' equity, where we're going to see a reconciliation of our retained earnings. And then we're going to look at our statement of comprehensive income. So the first 4 statements are required, but you'll see GAAP now requires some reconciliation from net income to other comprehensive income, and you'll see this last statement, and it might be combined within the income statement. So accounting information should be fair, complete representation of the firm's economic performance, their financial position, and the firm risk. And financial information, accounting information should provide relevant information that we can use to forecast what the future earnings or future cash flows would be. So we're always looking for earnings and future cash flows. GAAP is generally accepted accounting principles, and that is what guides the valuation and the measurement methods that are used within the financial statements. And the SEC, the Securities and Exchange Commission, basically they have the authority, and they're the ones that set the accounting principles that we use in our 10Ks and our Qs. Right, so our 10Q is our quarterly statement and our 10K is our annual report. And then FASB, the Financial Accounting Standards Board, they are who determine GAAP. And then the SEC gives us a format for the 10Q and the 10K, which is our annual report. And that's what shows us that in item 8, you will have all of your financial statements, and that you'll have the audit of those financial statements conducted as well. So when we look at the balance sheet, it's also known as the statement of financial position, and you see assets equal liability plus owner's equity or stockholders' equity. So that's how I like to remember it, ALO, right? So the asset portion of the balance sheet, that tells you the firm's operating decisions and their investment decisions. The liabilities and the shareholders' equity, that gives you the obligations that arise from those decisions that the company is making and how they are financing those obligations. So assets are those resources for which the organization has the rights to the future economic benefits as a result of a past transaction or event. And a firm can recognize an asset only for those resources which the firm can predict and measure that future benefit with a reasonable degree of precision and a reasonable degree of reliability. So we usually categorize assets into current assets, investments, property, plant, and equipment, and then intangible assets. And then liabilities, these are the future sacrifices of resources to satisfy our existing obligations. And typically we have current liabilities and non-current liabilities. Current liabilities are those obligations that you are going to pay within the year, whereas your non-current or long-term liabilities, those are usually greater than 1 year. Shareholders' equity, that is the residual interest or claims. And those are amounts that are initially contributed possibly by shareholders for an interest in the firm by buying a stock. It could also be the cumulative net income in excess of those dividends that have been declared, because once an organization declares dividends, they have to pay them. And then shareholders' equity also affects the recognition of some values of certain assets or liability, like treasury stock is where you purchase back as an organization your own stock. So now when we want to assess the quality of the balance sheet, what the analyst needs to recognize is that the resources of the firm that generate future cash flows appear as assets only if they were acquired from another firm and they have a measurable acquisition cost. Then if we purchase non-monetary assets, those are reported at the acquisition cost, net of any accumulated depreciation or amortization. So these are two different ways in which we value our assets on the balance sheet. And also we have the right to use resources and commitments to make future payments that may not appear as assets and liabilities. So we have non-current liabilities, and those usually appear at the present value of the expected cash flows, and we discount that at the interest rate prevailing when that liability initially arose. Now, if we want to look at the income statement, this is measuring our operating performance, and this gives us information about profitability for a firm for a period of time. And then under the accrual basis of accounting, revenue is recognized when it has completed all or substantially all of the revenue generating process by literally delivering the products or the services to the customer. And it is also reasonably certain that you've satisfied that liability or you've generated that asset, that you can measure it reliably, and then you can record the revenue. And so basically there's accrual basis of accounting and there's cash basis of accounting. And accrual basis of accounting is what is followed under GAAP. Think of cash basis of accounting as that is followed under tax law. So then we have the statement of cash flow. And here is where we're trying to assess the firm's ability to generate free cash flows. And we're trying to predict the future free cash flows. So there are three types of categories or activities that we call them in the statement of cash flows. We have operating activities, investing activities, and financing activities. And then transactions that are not directly involving cash, they're usually disclosed in a supplemental schedule. They could also be the notes to the statement of cash flows as well. And the financial statement footnote disclosures, all the notes after the financial statements, provide a treasure trove of information for analysts and for us to help us in analyzing the financial statements. Now we want to look at profitability and risk. So here we would use common size financial statements where we're taking changes and we're taking percentage changes in the financial statements and then we're calculating ratios. So when you think of common size financials, you think of horizontal and vertical analysis. So if we're looking at a horizontal analysis, we're looking at one account over several periods. And if we're looking at vertical analysis, we're looking at several accounts over one period or 1 year. So we take our common size financials to basically prepare our forecasted financial statements. And forecasts are the inputs into what we put into our valuation model, and the quality of the decision rests with the reliability that we have of the forecasts. So forecasted financial statements rely on several assumptions that you as the analyst make about the future, and the amounts from those forecasted financial statements is the basis for our valuation modeling. And then when we value the firm, we have several different approaches, and the first three methods will give us the same value. So dividends, earnings, and cash flows, we will get the same valuation here. And then we could also do it based on the market as well. So what is the role of our financial statement analysis in an overall efficient capital market? Well, stock market prices react somewhat to a high degree of efficiency to some of the published information about a firm. And so an implication of a highly efficient capital market is that the analysts and investors have more difficulty in finding those undervalued or overvalued securities. So basically, when analysts makes their forecast or their predictions, and then the company comes out with their earnings announcement and it meet analyst expectations, typically we would expect the stock to rise. Now let's talk about the association between earnings and our share price, right? So when you're looking at performing a financial analysis, right, you're looking at providing that analysis based on forecasting and based on valuation of some key accounting measures. But you have to understand the relationship between accounting earnings and stock returns in order to foreshadow the potential of generating that positive excess returns through this analysis and forecasting. And there is some empirical research done by Craig Nicholas and James Wallen that might help. But basically, you would expect that if you meet earnings expectations, your share price will go up. But there have been several empirical studies that have shown mixed results. And where do we get all of this fabulous financial statement information? Well, the annual report to the shareholders, which is our 10K. And then we get quarterly reports, that's our 10Q. And you can go to SEC Edgar and get the information there. You also have prospectus or some registration statements, and the annual report also has the management discussion and analysis. It has the letter to the shareholders. So there's a whole bunch of information that we get in that 10K. Thanks for watching.